BlackBerry jumped over 13% in a single session. By Friday, it was trading down 5.6%, last seen near $4.97. That whipsaw is the story, not the deal itself. The announcement confirmed a deepened partnership between BlackBerry and Nvidia, embedding QNX into the Nvidia Drive Autonomous Vehicle platform. On paper, that reads as a major win. QNX is already installed in over 235 million vehicles worldwide. Nvidia Drive is the leading AI computing platform for autonomous and assisted driving. The combination sounds like a logical fit. But the market's reversal within days raises a harder question. Was the initial surge a rational repricing of BlackBerry's long-term value, or a momentum-driven reaction that ran ahead of the underlying business? That distinction matters more than the headline number.
Most coverage of this deal focused on the partnership announcement. Far fewer examined what QNX's business model actually means for BlackBerry's revenue. QNX is a real-time operating system. It does not generate revenue the way a cloud software platform does. BlackBerry earns royalties on a per-vehicle basis. That means every dollar of revenue growth from this deal depends on two variables the company does not control: how many vehicles OEMs produce and how quickly those OEMs adopt NVIDIA Drive-based systems. Global EV and autonomous vehicle deployment timelines have been pushed back repeatedly. That is not speculation. It is the documented pattern of the past several years. The gap between announced partnerships and actual production volumes has been wide, and it has stayed wide. This is the structural reality underneath the headline. The NVIDIA validation is genuine. QNX being selected for next-generation AI-powered vehicles is a real signal of competitive positioning. But validation and revenue are not the same event. They can be separated by years. BlackBerry's most recent quarter showed revenue of $157.96 million, beating estimates of $144.27 million. Revenue was up 10.1% year over year. Those are encouraging numbers, but the company's full-year 2027 earnings guidance sits at $0.150 to $0.190 per share. Against a stock that traded above $5 on deal excitement, the PE ratio reached 62.77. That is a significant multiple for a business whose core growth engine depends on an automotive production cycle that remains uncertain.
The consensus framing treated this deal as a new catalyst. That framing deserves scrutiny. According to analysts and reporting, the NVIDIA partnership deepens an existing relationship. It does not create an entirely new revenue stream. QNX and NVIDIA were already connected in the automotive ecosystem. What changed is the depth and formalization of that integration within the Drive platform. That distinction carries weight. A company landing a brand new enterprise contract has a different risk profile than a company extending an existing arrangement. The former represents market expansion. The latter represents market consolidation, which is valuable but in a different way and on a different timeline. The critical variable is OEM adoption velocity. If NVIDIA's growing dominance in automotive AI computing accelerates the transition to drive-based systems across major manufacturers, QNX royalty volumes follow automatically. That is the upside path. It does not require BlackBerry to win new business in a competitive sense. It requires the broader automotive industry to execute on a transition it has already signaled. That is actually a more durable setup than it appears. BlackBerry is not fighting for shelf space. It is already embedded. The question is whether the shelf becomes more valuable.
Two data points from the same week cut against the bullish narrative. In the 90 days prior to the surge, company insiders sold 73,171 shares of BlackBerry stock. The CEO sold 27,066 shares at an average price of $3.56. The SVP of a key division sold 29,908 shares at the same price. These sales occurred before the deal announcement drove the stock materially higher, but they are part of the documented record. Insider selling does not automatically signal deteriorating fundamentals. Executives sell shares for many reasons unrelated to business outlook. But in the context of a stock trading at a PE above 62 and carrying a consensus analyst rating of hold, the pattern adds texture. Royal Bank of Canada reaffirmed a sector perform rating with a $4.50 price target. Canaccord Genuity lowered its target from $4.60 to $4.40. The consensus price target across analysts sits at $4.88.
On the day the stock was last reported, it traded near $4.97, just above that consensus target, following a significant decline from the deal-driven peak. That alignment between the current price and analyst targets suggests the market has largely absorbed and discounted the deal's near-term value. The remaining question is whether the long-term thesis, QNX as an infrastructure layer in the autonomous vehicle stack, earns a higher multiple over time. Two paths forward are structurally credible, and neither can be dismissed. In the downside scenario, autonomous vehicle deployment timelines continue slipping. OEM adoption of Nvidia drive-based systems moves slowly. BlackBerry's royalty revenues grow at a pace that does not justify a premium valuation. The stock drifts toward or below the analyst consensus target. Momentum traders, who drove much of the volume spike, rotate out as the catalyst fades. In the recovery and upside scenario, Nvidia's position in automotive AI computing solidifies faster than expected. Major OEMs accelerate their transitions to drive-based architectures. QNX, already embedded in over 235 million vehicles, becomes the de facto operating system layer for the next generation of AI-powered transportation. Royalty volumes scale without BlackBerry needing to win competitive battles. The infrastructure is already in place. The lean here is conditional. If the timeline for autonomous vehicle adoption compresses, driven by regulatory clarity, declining hardware costs, or competitive pressure among OEMs, BlackBerry's positioning becomes genuinely valuable. The royalty model, often characterized as a weakness because it is passive, is also a strength. It scales without proportional cost increases. But the base case remains cautious. Revenue growth of 10.1% year-over-year is real progress. The earning speed, 6 cents per share against a 4 cents estimate, suggests operational improvement. The Nvidia deal adds credibility to the QNX franchise. None of that, however, resolves the fundamental timing problem. The deal is real, the revenue is not yet. BlackBerry is not a broken company. It is a company whose most important asset is embedded in an industry that keeps moving its own finish line.